Part D of the exercise asks us to find the carrying value of the bonds as of the close of business December 31st, 2014. The second question is, what is the carrying value of the 20% soon to be retired bonds on the same date? The formula to calculate carrying or book value is to take the par value minus the unamortized discount. That will equal carrying or book value for the bonds. Par value was given, $250,000. Unamortized discount. Unamortized. You have to solve for that. To find the unamortized discount, you will take the total discount amount, $13,125, and subtract the amount that has already been amortized for the 6 years that has passed. So you'll take $13,125, the total discount, minus the already amortized $5,250 to figure out what is left to be amortized. So there's our formula, $13,125 minus the already amortized $5,250 gives us a total of $7,875. Subtract your unamortized discount amount from your par value to get a carrying or book value of $242,125. Now the second part of the question asks you what the carrying value is for the 20% of bonds to be retired. To make your life simpler, just multiply those figures by 20%. Multiply the par value times 20%. That will give you $50,000. And multiply the unamortized discount by 20%. That will give you $1,575. Subtract that from the par value of the 20%. So $1,575 minus the $50,000 should give you a carrying value of $48,425 for the 20% of the bonds to be retired. So that is the answer to Part D of the exercise. Now we are ready to move on to Part E of the problem. Part E asks, how much did the company pay on January 1st of 2015 to purchase the bonds that it retires? We see from the information up here that the company did purchase on January 1st of 2015 20% of their outstanding bonds by paying 108.25% of the price. So to solve E, we're going to use a formula similar to the one used in Part A. In Part E, to figure out the cash amount paid, we will take the par value of the retired bonds, not the entire bonds, but the retired portion, times the purchase price, again expressed as a percent. That will equal the cash that was paid out. The par value of the retired bonds we solved in the previous Part D. Par value of the retired portion, which was 20% of the total. 20% of the total par value, $250, is $50,000. So that's the par value of the retired bonds, and the 108.25% was given. Multiply that by the $50,000 to arrive at total cash paid of $54,125. The company paid that amount to retire $50,000 worth of par value bonds. In Part F of the problem, we are asked to identify the amount that will be recognized as a gain or a loss from retiring these bonds. In order to calculate whether the bonds were retired at a gain or loss and the amount of that gain or loss, we will need to compare the bond's carrying or book value to the cash that was paid. The cash that was paid out was solved in Part E, the previous requirement. We figured out that amount to be the $54,125. $54,125, which was computed by taking the purchase price times the par value of the retired bonds. The carrying value was solved earlier in this problem in Part D. The carrying value of the retired bonds is $48,425. We'll compare the carrying value to to the cash paid out. You can see that the cash paid was in excess, was greater than the carrying value. Anytime that is the case, when the cash paid is greater than the carrying value, a loss will be recognized. If this had been the other way around, if the carrying value had been greater than the cash paid out, there would be a gain recognized. Here again, there is a loss because the cash paid of $54,000 is greater than the carrying value. The company had to pay more than the value on their books for this liability, resulting in a loss. And finally, in the last requirement to this problem, we are asked to prepare the journal entry to record the bond retirement at January 1st, 2015. In order to do this, let's go ahead and start with bonds payable. We know bonds payable is always recorded at par, and since we're recording the journal entry for the retirement, only the retired par value will show. That amount was calculated earlier in Part D by taking the $250,000 and multiplying it by the 20% that was retired. So the $50,000 par value will be debited to bonds payable to remove the liability from the company's books. Next, we will debit the loss on retirement of the bonds payable. And again, the loss was calculated earlier in Part F. So that amount is debited just as we have debited previous losses. Next will be to credit the discount on the bonds payable that were retired. And this amount, again, was solved earlier in Part D by taking the total discount and multiplying it by the 20% retired. That is the amount still remaining on the company's books and therefore must be removed. Discounts normally have a debit balance, which is why we're crediting it here to get rid of that discount. And ultimately crediting cash for the amount that was paid. And that amount was solved earlier, actually in Part E. And it's always a good habit to add up both your debit and credit columns. You will see that both columns equal $55,700, meaning your debits equal your credits and your journal entry is in balance. And don't forget your explanation. To record retirement of bonds payable at a loss. That concludes the algorithmic version of exercise 10-11. Hope you've enjoyed the video tutorial of this problem.